All right, I'll give a little bit of instructions while we're getting started here before I get into it. There is a Q&A option on the Zoom call. So in this particular presentation, I'm going to get into the history stuff. I'm going to get going, probably get a pretty decent rhythm going. So if you got any questions, everything piques your interest, go ahead and throw your questions in the box. And then at the end, I'll be able to get to those. So if anything piques your interest, uh, or I could answer your question during the presentation. Let me double check one thing here. Okay, good. All right. It is 10 o'clock, so we're going to go ahead and start it. Let's see. Okay. All right, we're going to go ahead and get started, everybody. My name is Phil Parker. I'm with Everhart Advisors. Welcome to Everhart Advisors University. And today we're talking about lessons from market history, insights from past crises. So there is a chat, or not a chat feature, a Q&A box. So if you have any questions, if anything I say piques your interest, or if you have any questions, feel free to throw a question in there, and I'll get to those at the end. If anything, after this presentation, you can always reach out to Everhart, and we'll make sure we answer any of the questions that you might have. So I'm a wealth manager here and a lead workplace financial advisor on our retirement plans. And today I'm going to get into history. So a little about me. I'm a big history nerd. I read Russian Revolution and Winston Churchill biography books for fun. So I love diving into history and why. It's just about people. It's about how people respond to certain situations. It's interesting to see what's noteworthy. But what can we glean from that? What can we learn from history, and how do we apply it? So a big thing that we hear as advisors from clients and participants when big historical events that are going to negatively affect the market, possibly, or just economic things, we hear the phrase, "This time it's different." We hear that all the time. And as advisors, we push back on that often and say, "Well, how is this time different? We'll see." King Solomon said there's nothing new under the sun, right? In Ecclesiastes. So that's typically what we fall back on. But I am going to argue that when I went back and I studied these lessons in market history, what I found was, yeah, I think clients are right that this time is different. However, if it is different, we have to take the good with the bad, right? So a lot of times you just focus on the bad. I'm going to say, okay, what lessons can we learn? How do we apply it? And how do we build ourselves up to succeed in the future when it comes to investing, building wealth, and owning companies? So first thing that I just want to cover before we get into individual case studies of the past is, let's take a look at a broad picture of the stock market. The S&P 500, roughly 500 largest publicly traded companies in the U.S. Those change over time, but if we take a look at this index and say, okay, well, how has this performed? How has it done since 1926? So we've got about this chart shows 98 years, but we could actually add 2024 and 2025 on here to give us 100 years of history. And what's our average return? A little bit more than 10%. So when you own stocks, when you own companies, your expectation is that you would make 10% rate of return on your money. However, when we take a look at each individual year, when do we actually get 10%? Very rare, right? So we only have 2 years in here, 2004, 1993, when we actually had a 10 at the beginning, at the front of our return. And if we actually extend that out, say, okay, well, what if we go from 8% to 12%? Let's give us a 4% range at six times over 100 years. So what we find is, yes, in a long term, if you would to hold your investments, own your companies for a long period of time, you would expect to earn 10%. But individually, in individual years, you're probably not getting anywhere near 10%, right? It happens very rarely. So how do we get that 10%? Well, if we strip away the negative years and we just look at the positive years, on average, our positive years are positive 21.4% of the time. And the negative years are negative 13.4% of the time. So our first way is our positive years are more positive than our negative years are negative, right? So if we just had 50-50 positive years versus negative years, we'd still get pulled up into the positive side of things just because our positive years are stronger. But then if we say, okay, but let's look at each year. Well, we actually have more positive years than negative years, right? 3 out of 4 years are positive, which is great. So we have more positive years and our positive years are stronger. However, that does mean that 1 out of 4 years are negative, right? So that's the price of admission. If you want 10% rate of return, if you want to compound, grow your wealth over a long period of time, the price of admission is the short-term drops in the market, right? Short-term volatility, it's inevitable. Long-term growth is persistent. So we would expect short-term volatility. If you own stocks, that's what we're gonna expect. Volatility is normal, not exceptional. Here's some great investors' wisdom. I like, Warren Buffett. There's a lot of stuff, we got by owning great companies, you can just forget about all the noise and the irrational market fluctuations and slowly get rich. That is a great sentiment, right? We can make money in the long run. That is very difficult to do. So we have to get ourselves in the mindset that volatility is normal, not exceptional. When a client calls and the market's been down for a period of time, and they say, hey, what's the plan, Phil? Well, the plan already exists. We already have created your financial plan. We already have an investment strategy, assuming that these market drops are going to happen, right? So that's the way you've got to approach this thing. If you can't approach investing, owning companies through cycles, through corrections, through these things, you're going to be in trouble with building wealth, because when decisions are made emotionally, it can be detrimental to your wealth building in the long term. So the difference when we're going to explore some of these things, there's a crash, like a stock market crash versus just normal business cycles. A crash is going to be sharp. It's going to be fast. It's going to be pretty big, right? So what we find is we don't know when these things are coming. We don't know how long they're going to go down, how long they're going to recover. What's the total loss? What's the total gain? We don't know any of this stuff. We just know that it regularly happens. So today, what I'm going to try to get into is how do you mentally prepare yourself for some of these large market corrections, market drops, from what we have learned in the past. Okay, so let's get into our first case study. Real popular one, the Wall Street crash of 1929. Now, I actually debated not bringing this one up, because the more I studied this stuff, the more I studied the consistent drops, the more I kind of got into the mindset of, well, maybe this time it is different because we've changed, because this is 100 years ago, right? Because technology has changed, government oversight has changed. People's just general knowledge of building wealth, the 401k, all these things are radically different today than they were back then. So we say this time, if someone says this time is different, yes, but in some positive ways, and we'll get into that. And that's a common theme I found in all of these. So big thing to know about the Wall Street crash of 2029. There is also the Great Depression that goes along with it. And so I think if you don't really take a deep dive and study it, a lot of people think Wall Street crash of 1929, Great Depression, same thing. And yes, they coincide, they're at the same time, but there is still debate on which event triggered the other one, right? Was it a Wall Street crash and a stock market crash, and then all of a sudden we had a Great Depression from it? Or was it a Great Depression did that? And it's a little bit of both. So the climate at this time was wild, rampant speculation. People were borrowing to buy stocks, and not just a normal, typical, healthy leverage or margin. I mean, people were barely putting any money down because there was loose lending practices. And these were not sophisticated investors. I mean, we're coming off the 1920s, a roaring 20s. We've seen huge market upswings. Everyone's taking a look at it saying, I want to get a piece of that. And they're way out in front of their skis. They are highly over leveraged. Lack of regulation. There was a lot of fraction when it came to the banking industry, not a lot of regulation, some very bad practices, economic stressors. So there was a lot of stuff coming on, and we were coming out of the roaring 20s. But at this time in 1929, the cracks were starting to appear, right? So we had actually overproduction in farming, and so we started to see a huge drop in revenue from farming. The technological limitations. This is a big thing, a common theme I also found going through studying these different periods and histories where just where we are today versus where we were 100 years or 50 years or even 40 years ago, we see just big changes in technology. Information moves so much faster now. And a great example would just be, and I'll get into the worst days in the market at this time, but just where orders would come through on tickets, and the ticketing technology was so slow, there was so much movement in the market that day that even though the markets had closed, those tickets kept coming through hours after, and so people really didn't know where they stood until after the market closed, and so it just really created a lot of issues. And then panic selling. Not really trading on any fundamentals, any good practice at all, understanding owning companies, but people just wanting to avoid loss and just selling at all costs to the detriment of their portfolio. So this one was a big one. Obviously, what we found was the worst 2-day back-to-back market performance was about a quarter of the market wiped out in 2 days. That's Black Monday, Black Tuesday in October, late October. Over a period of time, about 90% of the stock market value would go down. It would take almost 2 decades to completely recover if you own it this time. And that's a big reason why I debated not even bringing it in. It's so different. Huge legislation came through, completely revamping the banking industry, FDIC insurance. So for people, yes, if you own stocks, you own the risk, but now there is actually insurance if the company that's holding your investments fail, like a brokerage house or banking. They really separated investment banking from commercial banking. The right hand not knowing what the left hand is doing. Lending practices tightened up. And really what we found and what I've studied as I've studied this stuff as we move through history is the Federal Reserve kind of sat on their hands in this one. They were not quick to act. And as we look at other case studies on this thing, the Federal Reserve moves in a lot quicker. And the government props up and in some ways moves on interest rates or tightens lending, those kind of things to make sure that stuff is taken care of. What I found was interesting is how even though it is so long ago, so different than what we see today, how it's still in the people's back of the mind that they think, yes, this could happen. And in some ways there is, still a possibility of big losses inside the stock market. But to see a similar Great Depression is fascinating. So this is a chart that popped up from 2012. This one popped up in 2014. And what this is showing is the Dow Jones back in 1928 and 29, and then 2012 to 2014. And it just shows a similarity if you're looking at the actual movements in the market. And if you can see where the pattern was first identified, taking a look back saying, uh-oh, we are due for another Great Depression. Look at this thing. And it even has a drop here that mimics it. And so you can see at this point in 2014, people are getting nervous going, oh no, the Great Depression is coming. And guess what didn't happen, right? We didn't get another Great Depression. Actually, from this point on, the market did a double and a half over 10 years and two doubles in about 12. And actually, if you take the same time period, this is the S&P 500. If you take that same chart and you actually say, well, let's actually look at a percentage base, not of actual movements in the market, it's significantly less menacing and a little bit more flat. So in this case, be wary when you're seeing information that's saying it's another Great Depression or it's another dot-com bubble. It's the same thing. We're tracking the same. It's not necessarily. You can make data kind of, if you're looking for a correlation, you can find it often. So you just want to be cautious when saying these things are repeating, right? Because if we are going under the assumption that, yes, it is different this time. We've got completely different regulation, different technology, different economy. We're not an agrarian economy anymore. We're a service-based economy, all very, very different situations. And that's why we just didn't see a plummet in this time. So yes, history doesn't repeat itself, can rhyme, can look like itself, but we want to learn and say, it is, we have developed as a country, as we're taking a look at the stock market. Let's move forward. So we're going to jump ahead about 50 years to the 1973-74 bear market. This is an interesting one. A lot of correlation post-COVID. So in this bear market, we saw a decline of almost 50%, about 48%. Let's see, this was driven by the oil embargo, the energy crisis due to the tensions in the Middle East. We had high inflation for a long period of time, very high interest rates, and we actually saw an economic recession during this time period. Political instability. Richard Nixon was impeached at this point. A lot of division and a lot of change, and so people have pointed to this time and say, "Hey, this looks really similar, right? We've got we're having tensions in the Middle East. We've got maybe not an oil embargo, but we are seeing some trade disputes going on. We've got an energy crisis. Oil prices are going up. We did have a period of high inflation in 2022, which caused rates to shoot up. We're politically divided, right? We're all over the place. And so is this the same? Is it 1973, 1974? And the answer is no. Wasn't accompanied with a recession. It's different tensions with different country in the Middle East. And the political instability, arguably, we have that all the time. There's always division in the country, and it hasn't gotten to a point in which it mimics this exactly. So if you are going to apply the same situation to it today, there is difference. The problem was, this is an actual Business Week headline from 1979 at the same time, the death of equities. So how inflation is destroying the stock market. So what happened was, if you were invested through this decade, you didn't see the returns in which that you would normally like to, right? And so you did underperform maybe historically than what you'd expect owning equities at this time. However, if you were disciplined through this point, if you were continually saving, so in this case, if we applied it to today, if you were showing the disciplined saving of like a 401k and you were saving throughout that time, it actually did reward savers and investors, because through a 10-year period in which you weren't seeing necessarily the returns, once the market did recover, you made a lot of money. So a big lesson that we can learn, that even prolonged economic stress and inflation, it didn't prevent long-term growth. So what we saw in the Great Depression period, where it took multiple decades to recover, this one recovered much quicker by comparison. And the other thing we see is worst economic environments often create some of the best long-term entry points. So if we are seeing a long-term downturn in the market, a great time to invest, right? We don't want to say, a lot of times people say, "Hey, should I be investing right now? Or am I just throwing my money away?" No, if we're buying when the market has been low, then we would expect to make money, more money when the market recovers. So just because we've got long-term economic stress, we're seeing it in the business world, the economy, doesn't necessarily mean it's going to hurt you in the long run with your investing. And often that would be a great time to invest. So those are two lessons that we learned from the 70s. Moving into the next decade, we've got October 19th, 1987, our second Black Monday. This was the largest single drop in a day. About 22% is what we saw on this one. Some of the reasons that we're driving this one would be a weakness in the market structure. So what I mean by that, again, and this is something where this isn't necessarily repeatable today because what we learned from this. But what happened is people were panicking. The stock market was delayed opening. However, futures and option markets were still open. So people were still able to sell, panic, or short the market. So when the markets did open, it just compounded on itself. Also, with new technology, having what they call portfolio insurance, that when markets were hitting a certain level down, these programs were just automatically trading and compounding. So again, we've got this new technology. People are implementing it saying, "Hey, we can protect our portfolios here." But what happened was it just compounded the losses. And then joined by our old friend panic selling there, everyone looking around, again, not trading necessarily on fundamentals of companies and value, but just panicking, trying not to lose a lot of money. And so it was this one incredibly temporary. What we learned from it, well, there was regulatory changes. So very quickly said, hey, we can't have this difference in these three different markets trading. We got to have everything moving together in one. And so regulatory changes trying to prevent that particular event from happening again. Also, what we found was a steep drop in the market, but no lasting economic depression followed. So again, following the Great Depression, thinking, well, if we have a drop in the market, it's going to trigger this long-term economic fallout. And so if you saw 1987 reacted, got out of your equities, it recovered very quick. Within 2 years, you had made all your money back from that drop. And actually, the annual return from 87 was actually positive, which is pretty interesting. And if you were scared out of the of equities in 1990s, I mean, you miss a substantial bull market run that made people that built a lot of wealth. So even sudden crashes can be short-lived. I mean, that's what we learned out of this one. The new technology, how does technology work together and allow for trading and for efficiencies, but and the regulatory changes would help prevent that. So we want to make sure that just because it goes down quick, just because it goes down fast, doesn't mean it's going to be prolonged. And if you miss that and you're already down, we don't want to trade out and trade at the bottom of that thing. Okay, I'm gonna receive some flack on this one, I think. I'm gonna combine the dot-com bubble and Great Recession just for time here. And these are two big ones. I think a lot of people on this call probably remember these, lived through this, were invested during this time. But this is January 2000 to December 2009, called the lost decade because it was 10 years. And if you held throughout 10 years, you actually did have negative return on your money, a little bit less than 1%, negative 1%, but still negative return. And so that's a pretty big deal. But when we take a look at what actually happened in that decade, for the dot-com bubble, it fell almost 50%, just about 49%. The global financial crisis, so 2008, 2009, actually fell 57%. So in reality, when we look at a market performance of a decade in which it was down just a hair under 1%, that's actually pretty incredible to go through the dot-com bubble, fully recover, and then go right back down to the global financial crisis, down 57%. With the climate here, with the internet explosion in the late 90s and early 2000s, the idea of what could happen with the internet, market efficiencies, ability to grow money, high P&E ratios. So you could argue overvaluing companies, right? If you want to go back and listen to Max Rodenthal's his EAU on stocks, it was incredible. He really took a deep dive into P&Es. But just really, just to take a quick high level, what's the profit of a company? How many times profit would it take for us to be able to buy that company? And in that time, we're going to see record highs, right? Well into the 20s, into the 30s, overpaying possibly for companies, and market concentration. People really throwing a ton of money into the tech sector, following that money, chasing that money, and eventually when it came down, people were really hurt by that. In the global financial crisis, we saw institutions that people relied on, right? The banking financial system, housing in America, both taking massive hits, which were really tough, and large, very big companies failing, going into bankruptcy. Lehman Brothers, Washington Mutual collapse, and people losing substantial, just losing or watching their value go down, right? If they trade it out. So what happened? What did we learn is what happened was it was 1% over the negative 1% about over that decade. The innovation's messy. Just because something had business had .com at the end of it doesn't mean that it was a profitable company. If you know what that little puppet is there, that's pets.com. That was a company that got outrageous valuation. They had a commercial during the Super Bowl, but really nothing to show for it. It was just an internet company that really was not very substantive, right? And so it went away. That irrational exuberance is real, that we don't want to be chasing the money. We don't want to be gamblers. We want to be investors. What are quality companies that we can buy and hold for the long term? The global financial collapse was felt intimate. That was real. People lost faith in the government and financial institutions. All those things were very real during this time, a very difficult time to be invested and to watch. half of your savings go away. But what we learned is diversification is essential, right? So we don't want to chase individual parts of the market. If we're watching one piece of the market, like technology explode, we don't want to only own technology. And we're seeing a lot of this today. This is mimicking with the AI, where I have people call in and say, I want to own AI. And I can show in the mutual funds, you can own AI, right? We want to invest in it, but we don't want to gamble on it. We don't want to throw everything in on one part of the market or one technology. Emerging markets during that same decade was actually up about 10% during that same time period. So if you were diversified, right, if you didn't just own the NASDAQ or just own S&P 500, you weren't down as big as 57%. That was the S&P 500. So diversification does help at that time period. So if you're frustrated maybe with your returns, when the large companies are the best performing sector in the market and you're lagging a little bit, that's okay, right? You want to be diversified for these exact moments, right? Discipline still wins again. Similar to the 70s, it was a very difficult time to watch your investments go down. However, if you were disciplined, if you kept your job and you were able to continue to save through this time period, post this decade, we've seen immense growth, and we've seen massive wealth build up. And so we really want to make sure that we're diversified, we're disciplined, and we're continuing to save even through the bad times. And time horizons matter, right? We want to make sure that if you have time to recover, if you are beyond a decade, you can own all equities. But if we're inside of a decade of needing our money, then maybe you want to start diversifying at that point, not diversifying, but bringing in bonds, and start to de-risk your portfolio if you are inside of that time where you might need your money. So we can learn some big lessons from that. Obviously, it's not a fun time to go through, but it doesn't have to crush you in the long run if you're invested properly and if you have the right mindset. Last case study, I want to look at COVID-19. This one was just really personal for people. It was a difficult time to go through, and it went fast, right? So it was the fastest market drop we had. About a third of the market value is wiped out in just over a month. Our old friend panic selling makes it back again, right? What's going on? A lot of emotion driven behind this thing. Are we, the global pandemic? We have polar politicization. We've got large market swings. We're seeing going up, going back. It hit very real for a lot of people with the travel ban. The NBA suspended its season, institutions closed. And I think we all remember Tom Hanks got it, right? When Tom Hanks got COVID, I think we all thought this is very real. That back then we were calling it coronavirus, right? So it was very emotional. Clients very concerned, and there was a lot of people that got out of the market and went to cash because they just couldn't deal with the big swings. Now, the only good news is it moved so quickly. A lot of people feel like they didn't have time to move, and it went down so fast that people weren't able to jump out of the market quick enough before it was down far enough where they possibly didn't think they were, it was worth it. But if you did, it recovered real fast. So it recovered in about 6 months. You made all your money back. And then the rest of the year, we had a huge growth followed by 2021. 2022 is down, then 2023, 2024, 2025, huge growth in the market, right? So this is where we learned a lot of lessons from our previous big drops in the market, where we did see interest rates go down, right? The government came in and lowered interest rates. We saw sector divergence, right? So we saw growth companies, things that were built on technology, possibly like the Peloton and things that could be done remote, saw big gains. Cruise ships, airlines, those kind of things suffered. But a big lesson that we learned here is that the market recovered before you felt good, right? So by the time the market was on its way back up and fully recovered, we were still under lockdown. We were still figuring out exactly what COVID was. So if you had waited until you felt good to get back into the market, then you miss some substantial earnings and it could negatively affect you. And so, as we look back at these this historical events, I kind of want to talk about what did we actually learn? What are some common lessons over and over and over again? Number one, crystal balls aren't real. So when you are taking a look at what people are predicting the future to be, I would ignore it, right? People ask me all the time, hey, what do you see in your crystal ball? What do we expect the market to do over the next year or two? And the answer is, I don't know, right? If you go back and read market forecasts from January of 2020, what is absent? COVID, right? The earliest I could find was in February. They were talking about some semblance of COVID, but I really struggled to find anything talking about COVID-19, coronavirus in January or December of 2019. So if you're taking a look at what we expect the market to do in 2020, it's not there, right? Bloomberg, I love this headline. It's a 100% recession chance for a recession in 2022, printed by Bloomberg. Guess what did not happen in 2022? A recession, right? The market, we saw it go down, but we didn't have a recession for that year. And so, if we're looking at what happened post that 2023, 2024, we saw a big growth. Michael Burry, so that's the guy who, if you ever watched The Big Short, read the book, or actually just in real life, he's the one that kind of came up with the credit default swaps and made a ton of money on the housing crisis, and mortgage rate and the mortgage-backed securities failing. If you look at his track record since then, it's not great. He's come out a lot about technology. He has a famous tweet where he said, just sell. And then he had to come back and say, I was wrong, in 2022, 2023. And so, yes, he was right and made a lot of money once. But what we find often is to be able to guess right, be right over and over and over again is very difficult. And then back to that chart where 2014 is going to mimic the Depression. It didn't, right? And so even if we're looking at technical stuff, if we're looking at emotion, or if we're looking at fundamentals, nobody knows what the future holds. I love this quote by Charlie Munger. People have always had this craving to have someone tell them the future. Long ago, kings would hire people to read sheep guts. There's always been a market for people who pretend to know the future. People have itching ears. We want to know what the future holds, so we'll listen to people. Listening to today's forecasters is just as crazy as when the kings hired the guy to look at sheep guts, right? And so when you are sniffing around looking for someone to tell the future, it is just as crazy as kings hiring someone to read sheep guts, because we don't know what the future holds. So what does this actually cost you? Let's look at some dollar numbers. What is at stake here? So if we take a look at the S&P 500 between 1995 and 2020, it's 25 years of history. This would have been, if you would have invested $10,000 up to the 25 years, what would you have, your 10,000 would have grown to a little over 85,000, an annualized return of about 9%. You say, hey, Phil, you told me 10. Well, look where that is. That's right at the COVID drop there. If you miss just the top 10 best days of the market, so you invested every single day except for the top 10, your investment goes from 85,000, growth only goes down to 39. If you miss the top 20, it shrinks to only 23,000. If you miss the best 40 days, you're actually in negative territory. You actually lost money. Over a 25-year period, you missed just the top 40 days, it actually goes down. Now, this is an unfair example, because this just has you missing the top best days. And you could probably argue, well, hey, Phil, well, what if I missed the 30 worst days? How much money do I have then? It's a fair argument. Except we just don't know when those days are going to be, right? And what's fascinating is we look at the top 30 days to that 25-year period, 80% of them are right smack dab in the middle of the tech bubble, financial crisis, and COVID-19. I mean, those are some wild, big days where if you jump out, jump in, jump out, jump in, if you're trying to just move more conservative, or when do you make that move? Well, the problem is if you ride the market down and have a big loss, and then you miss that 11.6% recovery day, that's pretty substantial, right? And so I highlighted to say, we don't know when these best days are going to be, or when the worst days are. So it just is not a great strategy to move in and out. A great strategy is to have a financial plan and say, okay, I'm just pursuing average rates of return, and I'm going to put myself in position where if the market's going to, when the market goes down, I'm going to be in a position to that's not going to wreck my financial plan, because there's an end to every single one of these things. I love this chart. It shows out all these big drops. It shows the big negative returns, and it shows how many months did it go from what we call peak to trough, top of the market to the bottom. How many months did it take to recover? On average, these big drops go down about 30%. It takes about 10 months to get to the bottom and about 13 months to recover. So we're talking about 2 years. 2 years is the average one of these things. Now, obviously, we go outside of that. We have COVID was only 6 months total, 1 month to the bottom, 5 months to recover. Those big ones that I highlighted, 74, dot-com bubble, Great Recession, those are longer. But there is an end to every single one of these things. And if you need money, if you are in retirement or approaching retirement, well, we can plan for that. We can create an investment strategy that isn't 100% stocks, and we can have money that's a little bit more protected for you if you're going to need that money. But if you're outside these periods and you're in your 30s, 40s, 50s even, then you are free to own equities and enjoy that 10% rate of return compounding, right? We just want to ignore the noise. This shows from 1980 to 2025. These red dots are intra-year lows. The bars are annual returns. So what we have is a intra-year low every single year, and a lot of these are pretty substantial. We actually hit minus 34% 3 times. Interestingly enough, 2 of the 3 ended up positive annual return for the year. So just because we're at some point down during the year doesn't necessarily mean it's going to be a terrible year. And if you panic and trade at some point on the bottom of one of these things in 2020 again, you're going to miss the substantial return that you experienced there. Again, if we knew when the top was or when the bottom was, we could do this. We just don't know. Timing the market requires us to guess right twice: when to get out and when to get back in. And dealing with clients getting back in is really hard because the market usually is recovered before you feel good to get back in. And when we're outside of the market, we risk missing that compounding, the sweet compounding returns of the market. This chart shows growth of $10,000 adjusted for inflation. So what this is purchasing power. Cash over this 30-year time period actually lost purchasing power, right? So you're getting your interest on your cash, and it's just not keeping up with inflation. Corporate bonds, we're up to 24,000, but nowhere near what we're receiving on large caps and small cap. Now, in this case, you might be saying, Phil showed me that chart, and I don't want to own small caps. Phil's chart shows me just large caps. He said diversification earlier, but not anymore. Well, these things held pretty tight to about 2018. We've just seen a huge jump in large cap stocks. Does that mean they're going to continue to outperform small cap? Definitely doesn't mean that's going to happen, right? But what we do like is the compounding effect of stocks, and that purchasing power of that $10,000 grows to 90. So huge growth, huge compounding. That's what's at stake if we're getting scared of moving in and out of the market. So remember, just the cost of admission is in a temporary 1 year, 3 or 5, even 10, we can see negative returns. But when we hold for long term, what we find is the worst that we've done is going to be positive, and really what we're expecting is about 10%. And the alternative is what? Owning cash, owning conservative investments that just the high end of those, 6.5%, 6%, 6.5% for bonds, 3% cash, just gets dwarfed by the 10% return in stocks. So depending on your time horizon, depending on when you need your money, that's when we can diversify away, right? Everybody wants to get that compounding 10% from stocks, but they don't want to see that largest loss. So we just need to mix in bonds. We just need to be a little bit more conservative when you need your money. But if we're outside of that time, we need our money, we want to own stocks, we want to be aggressive, we want to receive that 10% rate of return, even through the bad times, right? Because even that 10% rate of return, that average, that's including all of those significant drops that we saw. So What do we learn? What are we going to take away from this as we study the histories, we study those drops? Market downturns are normal and expected. Okay, so that's like the number one thing I want you all to realize, that it is not a, uh-oh, the market has been down. What are we going to do? That's not the time to make a change. It's not the time to make a move. We want to have a financial plan ahead of time, right? So when clients call me at the beginning of this year and they said, Phil, the market's been down. What are we going to do? I said, well, I didn't know that we were going to bomb Iran. I didn't know there was going to be tensions in the Middle East, but I didn't know oil prices were going to go up. But we assumed at some point over your life, there's going to be a drop. So our investment strategy reflects that. If you haven't had that thought or those conversations, reach out to us. We can have those conversations with you to figure out what is your plan? How are you going to last through these temporary declines? Number two, crises, they create opportunities. It's not just risk, right? And so for the example of, hey, it's different this time. Yeah, it is different this time. I mean, because there's technology, because there's changes, because we're in a completely different economic structure, there are opportunities as well. So we can take a look at these drops in the market and say, man, we're buying in cheap, right? If you're still working, if you're still putting money into a 401k, every time you get paid, every time that match goes in from the company, you're buying in cheap and get opportunity to make money on that. Number three, long-term investors are consistently rewarded, right? If we're trying to gamble, push a bunch of money into one position, make a bunch of money in a year or two, that can't happen. Can we do that consistently? No. Can you own companies and consistently make returns in the long run? That we have seen, right? And coupling with that, patience is a competitive advantage. If you have the patience to outlast other people, if you are able to buy when other people are selling, if you can think long term, not even all the way up until your retirement date, but beyond, and be patient, that is a competitive advantage in the stock market, and you would expect to build wealth over the long time. Peter Lynch, there on the left, I love this quote from him. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Sir John Templeton there, he disagrees with me. The four most dangerous words of investing are, it's different this time. And I would agree with him if we're using that as a reason to get out of the market. But if we can say, it is different this time. I don't think the Great Depression is going to repeat itself. I don't think COVID-19 is going to repeat itself, or the Great Recession, or the dot-com bubble. It is different this time. I do think that we can outlast this market, and it can be an advantage to me to continue to be invested. If you can look at it from that perspective, I think you're going to be in good shape. And the last one, I love this piece. History provides a crucial insight regarding market crises. They are inevitable. They're inevitable. Painful. I love that he adds painful in there. It is not an enjoyable experience, but ultimately surmountable, right? We can overcome these market downturns and build wealth in the process, which is pretty incredible. Okay, that is all I've got. That was a lot of history and my thoughts. Any questions on anything I've got? If you have a personal question and you want to reach out, you can always call us at 844-GOT-401k or email us at help@everhardadvisors.com. We will get to those as quickly as we can. You can always set up a one-on-one consultation so we can take a look at your investments and your financial plan and see what would be the best course of action to get you where you're trying to go. And if you need someone to hold your hand, tell you everything's going to be all right when the market's been down, we can absolutely help you out there as well. Our next EAU is how behavior shapes financial choices. So a lot of people are enjoying these things. There's our menu for the rest of the year, our schedule there, if any of those pique your interest. But that's everything I've got. Any questions in the Q&A bank? I don't know if there's a ton of questions on this one, unless you want some specific data on the Great Depression, or if anyone has any questions on October of 1929, but we'll see. Any questions out there? All right. If anything pops in your head, please email us at help@everhardadvisors.com. Thank you so much. for logging on and watching this thing. We appreciate everything y'all do, and hope this was beneficial. So thank you so much, and have a great day.